Hi everyone. Today we're going to be talking about gold, and I'm going to explain to you why you should hold some gold now, why it's going to be important for the near future. I'm going to go through the brief overview of precious metals, try to see whether they are fairly valued, compare fiat currencies and hard currencies, talk about the war on cash, about the petrodollar, and also the monetary system and the outlook for the existing monetary system, and see whether gold could play a role in the next monetary system. But before I start on this, you need to understand one thing. You need to consider gold and silver, precious metals, as currency. And when you talk about currencies, you look at what happened centuries and centuries of history, and the same pattern always appears, which is that governments are always tempted to create, to increase the money supplies, to create more currency, to expand, to pay down the debt, and so on. And if they do that reasonably, I would say, if they increase the money supply according to the GDP growth or slightly higher, it's fine. But when they do it in a at a much larger scale, usually, I mean, not usually, that always leads to a currency collapse and hyperinflation. And we can go back like centuries ago. This is the Roman Empire, and you see there, because before, I mean, it was not money that they could print. They used to have silver coins and gold coins as currencies. And for the Roman Empire, those silver coins, if you look at the content of silver, they couldn't produce more silver. I mean, slightly more, but so what they did, that they mixed the silver with other materials like copper, like zinc, obviously less valuable, and that enabled the Roman Empire to increase the money supply. So look at this, 100% silver content there, and then ended up with almost zero. And that's one of the reasons why the Roman Empire collapsed, because the currency collapsed. As you can see there, I researched and I see, why the Roman Empire collapsed. Disruption of trade, gold and silver drain, inflation to pay off debts, government raised taxes and coined more money with less silver, which led to inflation. That's a very important pattern. Keep that in mind, because we will go back to that at the end of the presentation. In terms of outlook, you see there the overview, the gold mining production worldwide. Russia has increased, China has increased. They are not selling their production, they are keeping the production for them. It just gives you an overview. Now, the demand for gold used to come a lot from the jewelry, as you can see there, back in 2001, 2006, and the demand has decreased dramatically. And now central banks are net buyers of gold. They used to be net sellers, you can see there in blue. And the one that increased quite a bit is the investment, the gold for investment. You can see here, this one increased quite a bit. The top 10 countries with the highest gold reserve, we've got the US, about 8,000 tons. We've got Germany, 3.4. Italy, France. Well, China is only 1,000 there, but I mean, the data, as often with China, is actually it's the official data, but it's closer to 4,000 tons currently, according to some other data which are more reliable than this one. It just gives you a view of who owns the gold. Now, in the last few years, because gold prices peaked in 2011 and since then dropped quite a bit, they went from 1,900 something, 40 I think, back to close to 1,000, just above $1,000. And therefore, the budget for exploration, as you can see, that's the blue line, drop there, and the gold discoveries as a result also dropped. So the production of gold is not increasing because of this. Silver, it's very similar. Silver is actually a byproduct. you don't go and mine for silver. It's very rare. Usually you mine for copper and other metals, and you end up finding silver. And because the prices of copper dropped also dramatically, then very limited production and discoveries of silver. And you can see there this the gap between the supply and demand of silver. The gap is the difference between the blue and the orange line here. Keep that in mind. I mean, when you've got a gap between supply and demand, usually prices go up. This one shows you the gold price. Actually, if you look at the gold price in US dollars and you compare it with the US real yield, the 2-year one, which is the yield adjusted for inflation, that's the inverse scale there. So when the interest rates are actually lower than the inflation, if you keep your money in the bank, you actually lose money with the inflation, and therefore it's actually good to own some gold, because gold is before all a preservation of value. That's what you have to really understand. When you look at gold prices, if they increase, for instance, in USD, the gold price in USD, it's not so much that the value of gold increase, it's more that the value of the dollar is going down. In terms of, is gold fairly valued, it's very difficult, obviously, to explain. But if you look at this Dow to gold ratio, how many tons of gold you need to buy the Dow Jones, you see there the ratio is actually pretty high, meaning that it's very favorable to, you've got a high equity market and rather low gold prices. If you want to trade with this, I mean, when it's very high here, you would start buying some golds, and when it's very low, you would start selling your gold and buy the Dow. If we would return to the year average, here the price of metal would be $1,840, and not, I think today we are 1,219. But just the message from this is we according to this one, we've got a pretty high equity market, and the equity market have been just inflated massively by central banks' liquidities. I'm not going to talk about this now, but it's actually a big bubble. This is the Dow Gold Ratio, so it shows you for like 100 years or more, like 116 years. You see where we are today. It's quite high, and if it goes down, then it would be favorable to gold. So now the gold to silver ratio. Also, it's important to trade. If you've decided to allocate a portion of your portfolio to gold, let's say 15-20% to precious metals, you would rather buy some silver when the ratio is actually very high, and buy some gold when the ratio is low. In terms of production, we currently are at 1 to 9 ounces of silver for 1 ounce of gold, and the ratio is around 70. I'm not saying that the ratio will go back to 9 to 1, but it could go back to much lower. I mean, in the past, in a long time ago, it was around 1 to 14, 1 to 15, the ratio, and currently it's 1 to 70, meaning that silver is quite cheap relative to gold, I would say, and therefore an attractive investment. That's the gold price for like the last 100 years. You can see the evolution. They are far from the all-time high, unlike like the equity market, for instance, or the bond market and other assets. They are very far from the all-time high. And the silver even more. I mean, silver went to above 50 in 2011. Today we are around 17.5. A long way to go, in my view, and we could go and test those all-time high in the coming years. I mentioned the currency part of gold, and also depending where you price. Sometimes you say, oh yeah, gold had a poor performance. Like I took 2015, poor performance, yes. In USD terms, yes. down 11%. But if you invested in rubles or in Brazilian real, the performance would actually have been 37, 33%. So this store of value for gold is very important. It's key. If a few months ago you invested in Turkish lira, you would be very happy today because the Turkish lira has been destroyed, and the gold price in Turkish lira has gone up a lot. Same thing with sterling. Those who invested in gold before the Brexit are probably very happy now because they managed to keep some value with their precious metals. So that's something very important. We always talk about the price of gold in USD, but depend in which currency you invest. Obviously, look at there also. That's the Ukrainian, yes, of course. Turkish lira I mentioned, but that was in 2015. Anyway, while talking the price of precious metals, you have to understand also that the price is driven mainly today by the paper gold and paper silver, which are just contract. It's just a promise to deliver the gold in exchange of a little paper or contract. But if you look at the cover ratio at the COMEX, which is the commodity index exchange, in Chicago, you see that there was a record of 442 ounces of gold claims per ounce of deliverable gold. It used to be a reasonable cover ratio, I would say, but nowadays you've got less physical metal and you've got more paper money, so you can manipulate the price with this paper. You can, short and so on, but there could be a big short squeeze if, let's say, just 1% of those investors investing in this paper money would ask for their physical gold, then the whole COMEX would collapse because they wouldn't be able to do it. They wouldn't be able to deliver. So that's also to keep in mind. When I say that the price has been manipulated, it's not a conspiracy theory. There was recently Deutsche Bank got caught, and in order to lower the fine, they only had to pay like 40 million, I think. They actually ratted the other ones, UBS, the usual suspect, HSBC, and so on. And you can see some conversation between traders saying, "Oh, we're going to whack the price of gold, and when it reaches a certain level, we're going to just destroy it," and so on. So manipulate it down. You've got JP Morgan, for instance. JP Morgan is very smart because it's the biggest player, I guess, on this paper market. And what they do is they try to lower the price of gold and silver with paper contracts, and then they buy the physical gold and silver because they know that it's going to go up. And once they manage to buy enough of these cheaper precious metals, then they will be happy when it goes up. Look at this. What is traded? Paper gold traded daily compared to the physical. The ratio is like 3,248 to 10.5, meaning that the price is obviously driven by this paper market. That's today. Now. Why I think, and now you can remember this, government greed, and when they need to expand, when they need to finance wars, when they need to pay down the debts, what do? They increase they just create money out of nowhere, and central banks have been doing that since 2008. It's a massive experiment. It has never been done before to such a scale. With the QEs, quantitative easing, they're just basically printing money, adding money to the market. It was just, a transfer of debt from U.S. households to banks, banks to government, government to central banks. The thing is, by printing money, you're not creating any wealth. It's just not possible. It would be too easy, and those experiments in the past always ended up in disaster. Currently, central banks are completely trapped. They can't reverse. Because if they do that, interest rates would go much higher, and given that the debt to GDP ratio today is very high for most developed countries, like 105% in the US, and most developed economies, I'm not talking about Japan because it's like 240%, and they would just be the end game. So they're going to continue doing so. They would never admit that they are wrong because now they are considered as like semi-gods. When they say something, the whole market, and they think they can create wealth, which is not the case, and that will end very badly for sure. If you look at the money supply, that's the M1, same thing, massive increase of money supply. What it does when you increase the money supply, well, you lose, that's fiat currencies, you actually lose value. And here it's the value of the US dollar, purchasing power, from the consumer dollar, from 1913 when the Fed was created up to today, and we started at well, 1, and today it's 0.04. So the USD in this like 100 years, a bit more, a bit longer, has lost more than 96% of its value. And obviously, when I mentioned gold is a store of value, then if you had gold back then you would have been able to keep this value. Now, another reason to hold some golds is this the war on cash. In the last 2 years, you probably heard, I mean, a lot of articles and actually facts that governments are trying to suppress cash. They talk about this in Davos last year. They talk about it in Davos again this year. They say that they want to fight against terrorism. And after a terrorist attack, you always have those articles in the press saying, oh yes, to fight terrorism, we need to suppress cash. That's the official reason. The unofficial reason is just make sure they can control your money. There is no money under the mattress. And when, for instance, when there is a bank failure, now we've got this bail-in rule, meaning that the bank, if it's about to go bust, would then take money in the deposit of its customers. That happened in Cyprus, that happened also in Italy, and that will happen again. So that's a rule. They don't want bailout anymore because it's not accepted now from a political point of view. So bear in mind that that's what will happen. And also banks can have the option to push to imply interest rates, negative interest rates to your accounts. That happen in Denmark, in England, in Belgium, many countries. We've got negative interest rates now, and banks from one day to another, they say, okay, well, now we're going to apply 0.5% on all your deposits and the money that you've got with us. When you don't have cash, you can't keep that at home. You can't keep the cash, everything in the bank. They control it. So once again, I mean, they won't be able to take your gold or silver. Well, that's very unlikely. And beware of this. And as a reminder, once in the bank, the money doesn't belong to you anymore. It's actually the banks owes you this money, but it doesn't belong to you. And you've got a lot of restrictions now. If you just want to go and get 1,000 euros at your bank, well, it's a lot of work. You need a notice and so on. They don't want you to take the cash. That's recent documents, 23rd of January from the European Commission, and that's a proposal for an EU initiative on restrictions on payments in cash. So that's happening. That will increase. It happened in Venezuela. It happened in India. It happened in many countries. South Korea, also Australia, and that's coming. Now we go back to the monetary system, and this you see it already, but just have the numbers in mind. The current monetary system is likely to change in the near future. I don't know whether it's 1 year or within 5 years, but I don't think it's sustainable on the long run, and I'm going to show you why. Central banks usually, when you talk about gold, say, no, let's not talk about gold. Gold is nothing, it's not important, and so on. They don't want to know audits of the gold reserve from the Fed because they don't want to give any importance to gold. But if you look at the move from some central banks in the last few years, look at Russia has increased its gold reserve dramatically as being a big buyer of gold. They're trying to buy everything they can. That's the China's also import of gold. passing through Hong Kong alone. It's huge as well. They're trying to accumulate as much gold as possible. So you wonder why they would do that. And this ratio here, I mean, the gold reserve as a percentage of GDP is quite important to look at. Sorry, the graph is difficult to read, but it's how many tons of gold compared to your GDP. The US is actually pretty low, it's 1.7. European Union 2.7, Eurozone 3.6. That's pretty high ratio. Here is Switzerland and Lebanon. It's not really relevant. Russia is 4.1, and China is trying to accumulate as much gold as possible to go to a ratio like similar, I guess, to the US, similar to the European Union, because in my view, when the existing monetary system will collapse and will need to be changed, the gold that central banks have in the own will be relevant, will be important for this new role in the new monetary system. And that's why they're trying to accumulate as much gold as possible. Why would the current system collapse? Well, I think that the dollar now is out of favors. We've seen it with China and the Saudis and the Russians selling the treasuries. So in gold, you see there it's a big move now. That's foreign treasuries held in custody at the Fed. Foreign central banks have been dumping treasuries. If China is accumulating so much gold, it's for the reason I just mentioned. It also because they have so much reserve priced in USD denominated that if the US dollar collapses, if it drops, then the gold will play as an insurance because the price of gold in dollar would go up if the the value of the dollar goes down. So it's also an insurance for them, and very important. When you talk about the dollar, you have to talk about the petrodollar, and this petrodollar was sort of born. I guess it was in 71 or 73. It was a deal between Kissinger and the Saudis, basically saying to the Saudis, we're gonna ensure your protection, but in return, you're gonna price oil in US dollars. So this way, with commodities being priced in US dollars, for those who actually have to buy treasuries, commodities, they need to own dollars, and for those net sellers, they actually receive dollars, and they have to recycle the dollar, and the most liquid assets to recycle and to get a bit of yield are US treasuries. So the world has been financing the US deficit for decades thanks to the petrodollar. But the thing is, the relationship between the Saudis and the US now has been deteriorating quite a bit in the last few years. They didn't like the deal with Iran because Iran is their main enemy in the region. I mean, the two big powers are Iran and the Saudis. And with the deal with Iran, actually, Iran gained power and the control over the region, more or less. So they didn't like it. They at some point last year threatened to dump all their treasuries and USD denominated assets because of the document with 9/11. So today it's pretty shaky. We can see that the Saudis are actually getting closer to China, and if they sort of turn, that would be, I guess, the end of the petrodollar. Many commodities now are priced in non-USD currencies. You've seen massive trade agreements and deals, energy deals between China and Russia. Obviously, they are not in USD. Between Turkey and Russia, between Iran and India, and I can name like dozens of those deals, not in USD. A lot of countries are turning their back on the US and on the US dollar. Recently, Turkey, Malaysia, Philippines, and I think with this, with the Trump also policy that has been bullying a lot of those that I mentioned, China and Europe and so many countries. I think that would just accelerate this phenomenon, this trend, and so if the petrodollar dies, well, basically it would be it won't be any reason to remain the reserve. If you look at the history of international monetary system, briefly we were before 1874 in bimetallism, which is gold and silver coins. Then gold standard between 74 and World War One, when obviously because to finance the war, then they couldn't keep this ratio of dollar to gold and deliver the gold in exchange of some dollar. There was a new one actually interwar period in 1922, but didn't last too long because of World War II. And then the Bretton Woods system, it was basically the gold standard, and that's collapsed in 1973 when the US president just said, well, it's no longer, I mean, in exchange of few dollars, you won't get gold. And since then, obviously, when you have the when it's linked to some metals, to something that you can't increase, I mean, you can't increase the production. You have a sound monetary system. But when there is no limit anymore, then that's what we're experiencing today. It's just a massive bubble, and bubbles end up collapsing all the time. I don't believe in this time is different. And if that happens, it wouldn't be a big deal. I mean, if you look at history, the different reserve currencies, you had like Portugal, Spain, Netherlands, France, Britain, US. So it happened in the past, and that will happen again. How the new monetary system would look like? It could be, I mean, that's the theory developed by Jim Rickards. It could be the SDRs, special drawing rights by the IMF. It's a basket of the 5 main currencies. You go the yuan, Japanese yen, sterling, euro, US, and the IMF is way less leverage than other central banks. It could bring new liquidities with this SDR. Whether SDR would be backed by gold, I doubt so. But in any case, I think that when those big powers central banks and big powers will sit down around the table to determine what would be the weight of their currency in the new currency, if it's the SDR, then the amount of gold that they own would be, I guess, important. So all those like this current environment is very favorable for gold. You've got fiat currencies that are being printed on a monthly basis like no time before, like never before. And that at the end I think will be very good for gold. So that's the conclusion. Gold, you can see gold as an insurance against the collapse of fiat currencies. And I mean, if you're like in Euro, we've got a Greek crisis coming back. You've got a lot of movements that want to, split from the Euro, exit the Euro, and so on. It could happen. Obviously, a collapse of the Euro. I mentioned the dollar. The yen is definitely going to collapse because basically there's just the central banks issuing some debt. Sorry, the Treasury Department issuing debt and central banks buying, demonetizing all the debts. So I think the yen will collapse, and others can collapse. I mean, you saw the Venezuelan, you saw Turkish lira, you saw the Egyptian sterling, and so on. So gold is an insurance. It has proved to be over centuries a great store of value, and a lot of I mentioned, a lot of events could trigger a surge in gold prices and gold and silver. Confidence in government starts to drop, existing monetary systems come to an end, inflation moves sharply higher, and USD collapses. That's just a few reasons. There could be many more. I'm even more bullish in silver than gold for the reason I explained before in terms of production and so on. Also because silver has got an industrial value and a lot of demand in all smartphones and so on. There is a big demand for silver because silver is not likely to be confiscated. Gold could be very unlikely, but silver even less. And silver is also the poor man's gold. It's much cheaper to buy a few coins of silver than gold. It's about 70 times cheaper. and we've seen a lot of demand for silver recently. So just prepare yourself, own a bit of these precious metals, and I think it will prove to be a good insurance for the events that will unfold in the coming months or coming years. Have a good day, and don't hesitate to share this video if you like it, and ask questions if you have some. Bye.